In this market update, I'm going to be talking about the yield curve and why it's good for predicting recessions, but not necessarily stock market returns. Hi, Jim Gore from THOR Wealth Management. Well, I want to add a little bit of information to a blog that Jimmy Stechschulte, one of our partners here at THOR, did back on July 11th talking about the yield curve. Just to refresh your memory, this is what he talked about in that blog. This chart here is looking at what is known as a normalized yield curve. Normalized yield curve is where shorter term rates are lower than longer term rates. It makes sense. If I'm a bank, why would I lend out, I want to lend out money 5 years from now. I want to get a higher yield than I'm getting today. And so when I have a normalized yield curve, I tend to lend out more money longer term because I'm getting paid for that money. However, you do have at times, which is an inverted yield curve, which is what we're looking at here. And that's where shorter term rates are higher than longer term rates. And when that happens, banks tend not to lend out longer term. Why would I lend out 5 years when I'm getting paid more in a 1-year note than a 5-year note? The incentive to lend out longer term is not there. Well, another way of looking at it, this is a chart here. I'm going to show two charts here of inversions. The first one here is the 10-year versus the 2-year Treasury note. The one point I want to make about this chart is you see the gray areas. Those gray areas are recessions. And you can almost, every single time, except for the most recent time period, we have had a recession after, there's a lag, after the yield curve has inverted. This makes sense because if banks aren't lending out money longer term because they're not getting paid to do so, that will restrict the economy and the economy goes down. It hasn't happened yet, but there is some concern that that is going to happen. You've heard about people talking about a recession for a while here, and that is because this is inversion. You can see here, though, that the inversion was worse back in the 80s from a 10-year versus a 2-year note. However, let's take it to a little bit more extreme. This is a 10-year note versus a 3-month Treasury, a real short-term instrument. And you can see here the same thing with the recession. Inverted yield curve is very good at a recession. Look at all the gray periods. It always occurred after an inversion. Now, there's a lag to that. However, we haven't had it here yet. But note, this is one of the longest time periods and is steeper than what it was back at any other time period going back to the 1960s. So we really had a steepening inversion yield curve where shorter term rates have been much higher than longer term rates for an extended time period. However, you don't see that gray chart, which is talking, looking at a recession. So this is why you're hearing about a recession is coming because of the inverted yield curve. The evidence is pretty clear, whether you use a 10 to 2-year Treasury or a 10-year Treasury to a 3-month Treasury, every single time you see a grayed out area, there is a recession. Doesn't mean it's going to happen right away, but every single time there has been a recession, except for this time. The question is, will we have a recession? Now, is this a good indicator for the stock market? I think this is very important. The stock market is different than the economy, okay? And if you look at this chart, this is looking at the 10-year to 3-month inversion after it's occurred the last 6 times, going back to 1978. And so what I did here is I looked at when it first inverted, what the price return on the S&P 500 is over the next 1-year and 3-year return. Now, keep in mind, this is only 6 indicators. This is not a very good study, but it's very indicative to show you that this is not an indicator for looking at stock market performance. Because you can see the first 2 in 78, when first inversion, and 89, the stock market over the next 3 years was up 30%. The next 2 time periods inverted in July of 2000 and also in February 2006. The next 3 years were negative 31% and negative 42%. However, when inverted on May of 2019, the market was up 50%. And this most recent inversion, and we're only a little bit over a year and a half into this, is that it's up 41%, which would mean it's the second highest. This is not a good indicator looking at stock performance. However, the inverted yield curve can be a very good indicator for what you do in your bond portfolios. And if you don't look at it for your bond portfolios and what you should do, if you should extend out maturities or not, that is something that you should talk to us about. As any questions or concerns, as always, reach out to us here at THORWealthManagement.com or email us. Take care, and I look forward to talking to you in a couple weeks.